Hey there, fellow investors. Welcome back to the Dividend Uncle channel, your reliable source for finance and investment insights served with a dash of Singaporean flavor. Today, we're setting our sights on Manulife US REIT, or as many of you know it, MUST. It's been a bumpy ride for MUST lately, with the stormy seas of the US office space market wreaking havoc on its journey. But fear not, my friends, because I'm here to break down the recent interview with Marc Feliciano, the global head of real estate at Manulife Investment Management, to understand whether the ship that is MUST can indeed weather this tempest. The current situation. As of August 18, MUST's unit price has dropped to a mere 7.9 US cents, reflecting a market capitalization of just $140 million. But hold on tight, because that's not the whole story. With its current liabilities outweighing current assets by over $880 million, MUST's financial voyage is facing rough waters due to a breach of a financial covenant. This has led to the suspension of dividend distributions for the first half of 2023, leaving many unit holders in a state of uncertainty. The possible solutions. Analysts have been whispering their advice to MUST, suggesting possible strategies to help the REIT navigate back into calmer waters. Trip Gant, CEO of MUST's manager, outlined three options: asset disposals, equity fundraising, and refinancing, all of which MUST's sponsor is exploring. But the question remains, which lifeboat should MUST board to ride out this storm? A beacon of hope. Enter Marc Feliciano, a seasoned figure with a profound impact on real estate and investments. His role as Manulife Investment Management's global head of real estate, private markets, holds the promise of expertise, strategy, and a lifeline for MUST. It's imperative to consider not only the words he speaks but also the potential currents of vested interest that may influence his commentary. Marc Feliciano is no ordinary commentator, he's a figure with a substantial role within Manulife Investment Management. Browsing Manulife Investment Management's website, he's the first to appear in the Leaders section. Credentials and considerations. Marc Feliciano's professional journey reads like a seasoned recipe for success, a background spanning diverse roles in real estate investment management, risk analysis, and performance evaluation. But here's the twist: he's not just a bystander observing from the shoreline, he's part of the larger entity steering the ship. As the global head of real estate, private markets at Manulife Investment Management, his role involves developing and executing global real estate investment strategies. Hence, while his expertise in real estate investment management is unquestionable, we must tread with caution, knowing that his comments might carry not just insight, but potential vested interest as a representative of MUST's sponsor. This is a reminder that even the most seasoned captains sometimes sail with a destination in mind. The sponsor's support. In the interview with Marc Feliciano, the sponsor's stance becomes clearer. He believes that saving MUST is absolutely possible, though time is of essence. The proposed sale of Phipps, a Class A office building in Atlanta, Georgia, is still on the table and ready for execution. However, Feliciano also emphasizes that new challenges have arisen due to a drop in the valuation of MUST's portfolio, causing a breach in the unencumbered aggregate leverage. Finding a comprehensive solution. Feliciano suggests that the sponsor and management need to reflect on the debt maturities in 2024 and 2025 to devise a comprehensive plan. One option on the horizon is generating a financing alternative to maximize the runway for the REIT until the first half of 2025. This approach aims to clear debt maturities, ensuring a smoother voyage ahead. The tug of war. The waters ahead seem to require a combination of strategies. While a sale of Phipps could alleviate immediate gearing issues, it might not suffice. Similarly, credit financing could help tackle expiries, but it may not reduce the REIT's high gearing level. A mixture of both options might be the key to maintaining MUST's best properties and keeping the vessel afloat. Interpreting Marc's insights. When Marc Feliciano suggests that Manulife US REIT can weather the storm, it's a signal we can't ignore. However, given his position as a representative of MUST's sponsor, we must approach his comments with a discerning eye. While optimism is encouraging, it's important to remember that his affiliation could influence the lens through which he views MUST's challenges and potential solutions. In his words, Feliciano underlines the importance of a well-structured capital, cash flow, and portfolio strategy. Selectively investing in assets that align with cash flow strategies and reinvesting through CapEx can maximize asset value. With a mindful approach, the sponsor and the management team of MUST can steer the ship towards stability and unitholder value. Yet, it's crucial to understand that any moves have to serve both must and the sponsor's interests. Conclusion. As we navigate through the tempestuous waters surrounding Manulife US REIT, one thing is clear: the ship's destiny lies in the hands of strategic decision makers. The sponsor's commitment and must management team's dedication are needed to finding a comprehensive solution might just be the guiding light that leads this ship back to calmer seas. However, let's not be blinded by false hope. The challenges ahead are formidable, and the path to stability is not without its obstacles. The stormy seas of the U.S. office market are unrelenting, and the decisions made in the coming months will shape Must's fate. Stay tuned for more updates and insights that help you navigate the complex world of finance, right here on the Dividend Uncle channel. Until then, keep your compass steady and your investment strategies sound. Remember, my friends, with every challenge comes an opportunity for growth. Safe sailing, and see you next time.